Hello and welcome to Financial Clarity Live. I am Josh Notes, your host today, and here with my co-host and business partner, Phil Maffei. How you doing, Phil?
Hey Josh, I'm doing good, thanks. How are you doing?
You know what? I'm changing. I'm always changing just a little bit. And today we're talking about something that's, relatively, obscure to the small business world. And so we're going to try to bring it to light, which is how interest rate cycles change decision making. I happen to reside about, 15 minutes as the crow flies from this picture, also known as Washington, D.C., where big decisions happen in D.C. that affect Main Street and Wall Street and other things. So today we're talking about interest rate cycles, and we'll get into some details about the past. But I guess, Phil, how do you view this topic, and how often do you actually talk about it with our small business clients?
It's more. I think it's probably one that's more relevant than most people think. There's maybe leave it at that. There's probably a lot here that if you understood a little better, you can make a little better decisions.
Hmm. Okay. Well, expect we'll get into that. All right. So, what are we actually talking about? What are interest rates and why do they matter? Let's see. I'll let the CFO answer this.
Right. People, unless you're of certain cultures, expect a return when they loan you money. So interest is the return on that capital loaned. I guess in the most simplistic way of thinking about it.
All right. And why does it matter?
Well, if you're going to borrow a bunch of money, you want to pay as little interest on it as you possibly can. And if you're going to loan money, you want to pay, you want to, get as much interest on you can. And then that push and pull is what drives, everything from buying a house and a car to buying a business to, setting your terms around receivables and payables and all of the things in between.
Right. Okay. So, I could see how these cycles affect your buyers of whatever product or service you're out there providing because it's affecting them personally, it's affecting and driving their business. But what if you say, well, my business doesn't borrow any money and it doesn't lend any money? So, again, why does this matter?
If your business doesn't borrow or lend any money, why does it matter? I mean, if you're trying to sell your business, right? If you're trying to do a valuation, it matters because the interest rate the Federal Reserve sets in short-term rates, right? I think we all remember when that goes to zero and the risk-free rate is effectively zero. From an equation of any investment looks appetizing in that world versus in a world where if you can go get 5 or 6 or 7% from a treasury, your business acquisition potential is going to look a little bit different, right? That risk-free rate is very different. So I think,
Hmm.
even if you're trying to exit at some point, understanding that will be helpful to get a perspective on of what the potential investor is looking at and how they're judging. Would I be better off just leaving my money in the bank than investing it in you because I'm going to get a better return or the same return for no risk, right?
That makes sense. And I think the other part of this is even if you and your small to medium sized business is not borrowing or lending, your supply chain for sure has borrowing and lending going on inside of it, unless you just consultant. Um, so, and then again, who are you consulting to, and do those clients have interest rate sensitivity going on in their world? Okay, that was a pretty good set of the basics. Let's kind of ground ourselves in you know where we have been and where we are now, and what does that perspective look like for you know so we, I guess, you and I were dating ourselves a little bit, kind of got our start in the corporate world in a low rate era, right? Where borrowing money was essentially free. And because of that, I like this blitz scaling, right? This is what we saw in the big tech. This is how we got to, six companies making up some gigantic percentage of the economy. And it also made valuations soar, which you're being compared with, no matter what business you're in. And a lot of M&A activity because it is really hard to say no to borrowing money at zero and then buying things with it. I don't know, that's my take on my, generation behind us of low interest rates. What about you, Phil? What's your take on it?
It was a bad idea, but we'll save that for another time.
Okay. Okay. We're still paying. We're gonna pay for that a little differently. All right. So low rates effectively made growth at all costs rational, and until they didn't, right? Because at some point, and not just in this low rate era, but there's been other ones, the merry-go-round stops going around. And guess what? This one happened during pretty much following a major world-changing event of kind of the COVID era. So um, the rate shock. All right, so here's what happened. Right, the Feds raised rates because they had to slow down inflation, and these are all the things that kind of came out of that. Right, like layoffs. Companies extended their runways. They had to focus on profitability. Um, they had to make only critical hires. They had to make down rounds where they were worth less than the last time they raised money. So that's kind of the shift that occurred, the rate shock shift. What's your view on that? Let's call it the last, 2, 3, 4 years.
Yeah, and I think, the most important thing folks watching this to give themselves a little history lesson, because this is, I think history doesn't often, doesn't repeat itself, but it rhymes, right? And
Mm,
I think, as you're saying, Josh, right, like in the last 20 years, we've seen this movie before. So, I won't tell you how it ends, but I think there is certainly a lot to be learned about, understanding where we are in this cycle, right? And moving accordingly and understanding the pressures that it causes. And for every good guy, there's a bad guy.
sure. Yeah, and I think, you know, we don't have a crystal ball. We can't tell you what the future holds, but we can tell you what patterns have existed based on our limited knowledge of the world. And that, there are things that let's just bring this back to a little different era when Phil, you and I got into the world as, young men. Um, a lot of other folks that were a couple years older than us were running really hot on real estate. And that carousel stopped going around. And at the time, it felt like anybody can just make $1 million in real estate because housing prices only go up until they go down, right?
Right.
And in this case, right, it's like startups could raise money almost, on the back of a napkin off of just an idea until they couldn't, right? And it's usually like one. I think sometimes it's a series of events, but sometimes it's like one event that actually changes things or kind of makes everybody in the financial markets wake up. And so let's keep going. Um, 6 decisions interest rates influence. Okay, so you talked about some of these. I'm gonna let you pick your 2 favorite and go into them, please.
Well, we already talked about valuations. I mean, and we talked that kind of leads right into the M&A conversation, right? Um, you know, I think there's the other side of this coin where, right, obviously when debt is cheap, right, it's easy to borrow money, right? And so you're going to do that, and you're going to do things like hire people and all of the fun stuff that comes with having a lot of cash laying around, and vice versa, right? Where we don't have the ability and easy access to capital, things start to tighten up. And I think those first two are related in that way.
Sure. So what about like folks? Okay, I've heard this before. I don't have a stat to back it up, but like a lot of really big businesses started off in kind of poor economic conditions because they had to start off with financial discipline. And then as things go in a better direction over time, their model ends up being kind of more, I don't know, fire tested, we'll say. If you're in this situation where we're calling this a relatively high rate based on the past 15 years, do you not start a business or do you just start it differently?
Well, I mean, yeah, I think, right, you don't just not do it, you just do it in a way that is efficient, or as efficient as possible given the environment you're in, right? Can't wait for, and again, it's high, but not historically, right? Like if you look at the
Right,
last 100 years,
right,
it's a different paint, you get a different perspective, right?
right.
So you can't just sit around and wait forever hoping, right? Controlling, something you can't inevitably control. It could be 10 years, could be 20 years, could never happen. Like you don't know. So I I don't think you necessarily, I think you just do things in a way where you understand that, and you know, those are the worlds where if borrowing's harder, raising capital in a different fashion may be more necessary than in a world where borrowing money is cheap, right?
Okay, so what you're
Doesn't
saying is
matter where you're at.
dress for the weather outside, not the one you hope for.
That's exactly right.
Okay, I like that. All right. So why is this? Because I think this is kind of at the crux of why we're having this conversation today on this platform. Why is this not just a big company problem?
Well, it's a macroeconomic event, and any good business person realizes that they are subject to the waves of the macroeconomic environment, right? So it's affect everything, your customers, all of the little things that go into an individual's day-to-day decision making. Ultimately, when enough of them do it, right, there's going to be a shifting, and you have to plan accordingly. You know, right? If someone's mortgage just went up because they had an adjustable rate on it, they're not going to be able to buy your gourmet, super expensive luxury product, right? So I think it's understanding what market you're operating in, and what the people in that market are, what they're subject to, right? What are the which winds are blowing in which direction?
So I feel like I'm kind of playing the in this conversation the founder owner of a business, didn't go to some fancy school. Yeah, I know what interest rate is, I know what the Fed is, but like it seems like it only moves by like these quarter points. Like how is that? Okay, it went up a quarter. Okay, it went down a quarter. Okay, they said they're not going to move it. Like, what do I do with that? Like, what do I do with that information?
You don't do anything with
Okay,
it. Unless
thank
you're
you.
trading treasury bonds, you don't have to really pay too much attention to the
Right.
quarter point up or quarter point down that the Fed is going to decide to move an
Okay,
interest
what
rate.
does it tell me? What does it tell me that I should be thinking about in the future? Like, how do I know if I'm heading towards a higher interest rate environment? How do I know if I'm heading towards a lower interest rate environment?
Well, we can go into economics 101, I suppose, in terms of, supply and demand, and all of that good stuff. But I
Sure.
mean, if I think it's more nobody has a crystal ball, but if you think interest rates are going to be higher in the future and
Okay.
you have a need to borrow money, you should probably do that sooner rather than later, or vice
Okay.
versa, right? So having some perspective on which direction the wind is blowing, right, you
Okay.
can act accordingly. So if the next Fed Reserve meeting, right, the interest rate's coming down a quarter point, maybe you wait till after that to, do your refinance, or whatever it may be. So, or vice versa. So I think it's, you're not going to be able to control anything, and in the grand scheme of things, right, like any one of these events is not meaningful, but it's more, those are all the telltale signs of which direction things are heading, and then understanding what happens in an environment where there's high interest rates and low interest rates.
Okay. Fair. And um, should I be paying attention to how big companies are responding to these things? Um, is that part of my responsibility as a business owner in small, medium sized business?
I mean, to the extent that those companies are in your industry or a part of your supply chain, then I think it's
Okay.
probably worthwhile.
That's what I was hoping you were going to tell me, because that's where my mind went with this is like, I mean, not all of them, but yeah, some of them are very much going to potentially affect what you're up to. All right. Well, so now let's look at like a strategic playbook, by rate environment. So we wouldn't have a single strategy if we were in looking at any situation that might go up and might go down. We'd have a couple. Um, so do we think this is the playbook? Straightforward. Obviously, it changes. Everybody's situation is different. We're not telling anyone what to do. Disclaimer, disclaimer, disclaimer. But like, is this what folks should be doing if we're heading into a lower rate environment?
Is that where you think we're going?
Is that where I think we're going?
I'm
Short
just
term,
playing
yeah,
devil's advocate.
short term, yes, I do.
Relative to what? Relative to 0%, I would,
No, relative to where we are right this second, like, right,
right, right. But I think that kind of illustrates that, it's like, it's hard. Again, you don't have a crystal ball. You can't be entirely sure. But I think that, as we always get back to, the economics of a particular deal, of a particular strategy, right, are going to be dependent on some assumption around, if you're trying to borrow money, right? Some assumption around what the interest rates are. So, being able to do the math and do some of that sensitivity analysis. So if it does go up or down, does it still make sense, right? Everybody, you alluded to that, I got this adjustable rate mortgage, or, I'm going to be great. And then the next thing you went from 0% to 7, and then, oh no, you can't afford to make the payments anymore, right? Like that's the
Right.
situation that most people can understand, that, there's, whether it's a home or a business, borrowing money to finance it in an adjustable environment, especially when you talk about 7, 15 years, whatever it is, that's the time frame over which a lot of these things move and make a big difference, right?
Yeah. And I think also, like, without us getting to this today, you got to have some sort of read on what's going on at a macroeconomic level across the globe, because whether it be war, pandemic, tariffs, supply chain shocks, like all these things do end up factoring in, and could mean, a lot to not only the interest rate environment, but really how you should be perceiving and, making decisions based on that interest rate environment. All right. Well, as we like to say on the show, the numbers don't lie, but a lot of times they don't speak without a CFO in the room. And luckily, we've got one here. So we'll keep talking. So, what to do Monday? Here's what you can do to audit your strategy for the current rate environment. Start with these 4 questions. Are we carrying debt that's now too expensive? If high interest is eating your margins, refinance it or pay it down. Don't let inertia cost you. Are we still operating like it's 2020? A lot of people got a lot of money rained on them from probably a one-time life event of the federal government, trying to keep the economy moving. If you're operating like that's going to happen again, that could be a challenge. So growth at all costs doesn't work when borrowing is expensive. Revisit your assumptions. What would we cut if rates stay high for 2 more years, right? We've talked about this, Phil, with some of our business partners, right? Scenario plan now, don't wait for the crisis to force the conversation. And are we positioned for an exit in this environment? So valuations are compressed. Build your exit plan around today's multiples, not yesterday's, and not your hope for tomorrow's. I add that one in myself. Give myself credit. You and I and everybody watching the show can't control the Fed. You can control, though, how you respond. So we're giving you the nudge to, like, prepare for that. Prepare to be adaptive in this environment, and be prepared for it to go in either direction and have a plan for each. But with that being said, Phil, I'd love to give you the final word on this topic, and maybe, just a little wisdom for the folks out there listening on how to stay attuned.
I was thinking about that last one differently. You don't want to do, and yesterday's, you want to try to figure out what tomorrow's is going to be, and work towards that, right? So I think that's where the forecasting exercise comes.
There you go.
I agree. Not your hope. What the data is telling you is going to
right
to the best that it does. So yeah, keep it forward looking, and that's that's how you stay out ahead of these things.
Fair enough. All right. So, like you said, not hope, but where the data is telling you. If you out there are challenged with what is the data telling you, we have some good news. That good news is that we believe we're experts in this, and we're helping owners and business founders like yourself to get an idea of where they stand. So if you need some financial clarity, it's here right now. Take a picture of this QR code. It's going to give you access to our Sustained CFO diagnostic, where we're just going to need 3 minutes of your time, 15 questions answered, and then we'll join you on a call to talk about what it says and what's next in your business, and how we might be able to help you, point you in the next direction, or introduce you to someone in our network that can help you get to the next level. But with all of that being said, we don't know what is coming in the future, but dress for the weather. Whatever it's showing you outside is probably a better representation than no forecast at all. So we appreciate you joining us today. I want to say thank you for joining Financial Clarity Live. If you enjoy this and you'd like a little bit more to dive in a little deeper, join our newsletter, Finance in Focus, for weekly financial tips, updates, and Q&A from this episode. And then, as always, we look forward to seeing you next week, 3 p.m. Eastern, when this goes live on LinkedIn, and our next episode, where we're going to help you gain